I'm Priscilla Barrera with the Investing News Network, and here with me today is Chris Berry of House Mountain Partners. Chris, thank you so much for joining me today.
Priscilla, it's great to be back with you.
So we're here at the 15th Fastmarkets conference in Las Vegas. I wanted to ask you about the first time you attended this conference. What was your highlight back then, and how has that changed today? Have certain conversations around lithium supply, demand, and prices remained the same?
You know, the first one of these I attended, I think the very first one was in Chile. I did not go to that one. I think the first one might have been in Toronto. And I just remember being in, the basement of the Sheraton in kind of it wasn't a conference room, it was a ballroom, but, maybe there were 100, 150 people there. And I just remember being excited that there were other people that I felt like they were like me. They were believers in technology and believers in this sort of commodity thesis. And, here we are today, year 15 to your point, and there are like 1,100 people here. And again, so I'm still very encouraged because there are a lot more people, I guess, like me that believe in the thesis and I think have come to grips or have started to come to grips with a lot of the challenges around building out not even just a domestic supply chain, but a more regionalized supply chain structure, which is going to take a lot of capital, a lot of intellectual firepower, and a lot of time. And that's one of the reasons why I think 1,100 people are here today. It's because we have this awareness of the challenges that we're facing. And so, but again, that's not a bad thing. I think it's actually a good thing that so many people are here and aware of it. And you're starting to see what I would call larger pools of capital or money with a long fuse come into the space, because that's what we really need to build out the supply chain.
The last time we spoke was at the end of last year, and back then you were mentioning how prices might stagnate. Are the current levels we're seeing more sustainable for this industry and for EVs to become more affordable? Will volatility remain when it comes to lithium pricing?
Well, I'll answer your last question first. One of my core views, I think, for the remainder of this decade is that price volatility is here to stay. I think and this goes beyond lithium. I mean, I think you could make the case. We saw what happened over the last year with nickel on the LME. Cobalt has done a roller coaster and is actually now down pretty substantially from its peak. So I think raw material price volatility is a core belief, I guess, for lack of a better phrase, that I have going out through 2030. And so that has implications, obviously, depending upon where you are in the supply chain as a miner or a cathode manufacturer or an OEM. Sometimes it could be good and sometimes it could be bad. And I'll let the listener think through who's going to win and who's going to lose. But nevertheless, so I think volatility is one of the main issues. And again, I feel like a broken record, but security of supply is obviously, that's again one of the reasons why 1,100 people are here, and it goes beyond lithium. But I'm sorry, the first question you had was...
Yeah, regarding the current lithium prices, do you think, are they more sustainable for the industry and to make the EVs more affordable, I guess?
Well, it's, yes and no. Is it sustainable? I mean, I think the market will ultimately dictate what is sustainable. I mean, obviously $80,000 lithium, even though it was the spot market and was in China, I mean, it was sort of a ridiculous number, to be honest with you. It got everybody excited. It got all the headlines, but I'm not going to say it wasn't real. It is a real price, but it is really focused on a small part of the overall market. The contract price is really what you want to focus on. Will we see $80,000 lithium again? Honestly, we probably will over the course of this decade, and it could go higher than that. I'm not predicting it. A lot of that depends on the supply response that we see in the next few years. So, again, volatility is the name of the game, I think, going forward. I do think we're very limited on the downside. Okay, the days of $6,000 or $10,000 lithium are ancient history. Where we land, I guess, if we do land, sort of thinking about a long-term average, is probably somewhere between, $25,000 to $30,000 per ton. That would be on a contract basis. Again, a little bit later this decade, and that again is dependent upon the success of the supply response. So lower than where we are today, but still very, very profitable for both hard rock and brine players that can get into production.
Right, and you mentioned security of supply, so I want to touch on the Inflation Reduction Act. We're reaching almost the 1-year anniversary of this legislation. How have you seen it impact the lithium industry, and what do you think is yet to achieve for the U.S. when it comes to building its domestic supply chain?
Well, the dust has yet to settle on the Inflation Reduction Act in the sense that the U.S. Department of the Treasury and the IRS are trying to figure out, okay, how do we advise taxpayers in the United States, corporate taxpayers, how to account for these very generous benefits. And so I guess I'll just make kind of a sweeping statement, and it is that the IRA is an incredibly economically beneficial piece of legislation to build battery infrastructure, whether or not it's recycling or cathode or anode or cell manufacturing here in the United States. I did a study on one battery producer, a Japanese battery producer, for them to build a 30 gigawatt hour factory here in the United States, again, making assumptions about gigawatt hours of production, and then, of course, their battery size. You assume a 75 kilowatt hour battery size, they'll generate about $1 billion a year in tax credits. And that's one factory at 30 gigawatt hours of production. And then you sort of say, okay, well, what else is in the pipeline, right? And you're looking at hundreds of gigawatt hours, if not at least a terawatt hour of capacity. So hugely beneficial for the downstream portion of the supply chain here. But again, if there's a problem or a limitation of the IRA, and again, many listeners I think are aware of this, is that it does not really address the permitting issues here in the United States. It doesn't smooth them over. It doesn't necessarily accelerate them. So, there is a mismatch here in the supply chain in the United States, and it's that you can take 3 or 4 years, say, and build a cathode facility or a recycling facility, right? You can get the permits, you can raise the capital, but if you're relying on friend or foe for your raw materials, that doesn't really solve the problem with respect to supply chain resilience and supply chain self-sufficiency. So I'm glad that the Inflation Reduction Act and the Bipartisan Infrastructure Law and the CHIPS Act are here and in force. About 8 months ago, about $40 billion had been committed to what I would call green infrastructure or green technology in the wake of the IRA, which was passed about 8 months ago. And now that number has gone from 40 billion to over 200 billion. And again, some of that's semiconductors, some of it's wind, it's not all battery infrastructure, but a lot of it is. And so I'm just happy to see the policy kind of signal from the Biden administration in particular, but we have to focus on the upstream to make sure this all really works in the long run.
Actually, yesterday, some producers also mentioned how they're optimistic about this type of legislation, not only in the US, but also in Europe with the Critical Minerals Act. Do you think that is also true for junior miners anywhere in the world? Should everyone in the supply chain be as optimistic?
Well, if you have a project in a country that has a free trade agreement with the United States, I think there's reason for optimism. Although every situation is different. Chile has a free trade agreement with the United States, but of course, Chile has gone through this spasm, if you will, of what I would call semi-nationalism or a threat of semi-nationalism. And, I'm not going to comment on what that's going to look like, but just the appearance of some sort of nationalization of strategic assets scares capital away. So, where does it go? Does it go to Argentina? Does it go to Australia? So, the short answer to your question is it's sort of a mixed bag. I think the Inflation Reduction Act in terms of who it benefits and how on the mining side. But again, I'd rather have it in place than not have it in place.
All right. And, it has been established so many times that we need more supply of raw materials, and we can't do that without mining. What do you think the mining industry can do better to attract the investments it needs?
Deliver projects on time and on budget. And again, I'm not sort of throwing stones in glass houses here. I know it's difficult, regardless of the jurisdiction, regardless of the metal, regardless of all of these different factors. I just think that, the mining business has to deliver on time and on budget. And I think one of the ways that you might be able to do that is through leveraging technology. I mean, we've had these interviews in the past, and I've talked about my belief in technology as a force for good, especially on the mining side. And so, I know technologies like direct lithium extraction attract a lot of passionate opinions on both sides. I happen to think that DLE is necessary. what it ultimately looks like. And in other words, if there's going to be tens of thousands of tons of, DLE produced lithium, I don't necessarily think so. In other words, just plain DLE projects, but you could see, and I think you will see DLE utilized for existing brine projects in the future here. And so that's a positive thing. And of course, the other technology that I've been pretty bullish on for a number of years now is recycling. Again, this is an ecosystem that doesn't really exist here in North America. I mean, there's collection, there's a little bit of black mass production, but that full kind of closed loop supply chain where I'm taking in the batteries, producing the black mass, and then putting that black mass through a hydrometallurgical process to leach out the valuable metals does not exist today. The good news is I feel like we're sort of on the cusp of seeing it happen, but we're a couple of years away. So I think technology is the key.
All right, and let's just talk a little bit more about technology and specifically direct lithium extraction. For investors that are listening today, what do you think are some of the key aspects to take into account about this technology, and how realistic are the timeframes for this technology to be commercially viable?
DLE is used today commercially. Livent uses it. I mean, this is no secret. Livent uses it down in Argentina, and Chinese groups use it in the brines in Western China because, at least in the case of Western China, it's a very problematic brine. The keys are, direct lithium extraction is not a single technology. It's not a single process. Your DLE process is going to be geared and engineered based on the complexity of your brine source. And it could be traditional brine that maybe has a lot of impurities. It could be a boron waste stream that has lithium in it. It could be, old oil and gas wells. And so one of the challenges, I think, in terms of picking winners, for lack of a better phrase, on the DLE side is, how scalable is your technology? Because, again, I would argue the DLE technology that you would use for oil wells is going to be somewhat different from, boron or geothermal or something like that. So really understanding the technology and making sure it's tailored is important. And then, again, it's just basic, like, has this management team ever done this before? What is their capability with respect to very complicated chemical processing? So, and there's some experience out there, but we need a lot more of it. And so that's the key.
All right. And, with the demand volumes expected, we know OEMs should be locking volume and ideally price as well. But how is sustainability playing a role? We heard producers say ESG is being built into contract these days. Will that become the norm? How do you see that evolving?
Well, yes, ESG is something that everyone's talking about right now. I think that, the OEMs in particular they're focused on that, and they should be, but they're focused on just getting volume. I mean, look at Lithium Americas and General Motors. I mean, General Motors is putting $600+ million in a bazooka and blasting it at this project to try and help it get, fully funded and operational. And that's great. And that's a very interesting project. And, we should know within a couple of years how ultimately successful it's going to be. I actually think it's going to be successful, but, that's one example. And then you've got another example where a company like Ford comes out a few weeks ago on their investor day and they say, oh, by the way, we struck 5 distinct offtake agreements, some of which are with established producers like the Albemarles and the SQMs of the world. And others are, earlier stage players like Energy Source on the DLE side. So, the OEMs are embracing this risk, and it's because they don't have a choice. They realize, look, we probably should have made these investments 5 or 6 years ago. We didn't do it, and so now they're trying to play catch up and help these mining companies kind of accelerate and bring the material to market.
All right, my final question for you today. Any final thoughts you can share with our investor audience when it comes to investing in lithium in the current environment? How can they cut through the noise in this season?
It's incredibly difficult, simply because if we're sitting here today and the lithium spot price is, let's say, $41,000, $42,000 a ton, and contract prices are generally higher, when you think about those numbers and then you look at the entire lithium cost curve, literally every single project, not just in production, but in production over the next, say, 10 years, every single project is economic. Okay, so what you have to do is you have to weigh the distinct risks, the non-economic risks for specific projects. So jurisdictional risk, Do you want to be somewhere in Africa? Do you want to be in Chile? Do you want to be in Indonesia on the nickel side? I mean, it's a personal preference, right? You want to handicap that though. And then again, which management teams have, and I've always said this, but like which management teams have the financial markets acumen and experience and have the technical chops to build lithium projects, whether or not it's hard rock in Western Australia or conversion capacity or, clay-based assets here in the U.S. or traditional brine. I mean, I think one of the potential limitations to bringing much more lithium on stream, and by the way, we're going to need about 140,000 additional tons every single year out to 2030. One of the real limitations here is finding all of that unique technical talent. And so, look, I mean, you don't wish anybody any ill will or any failure, but if there are failures in bringing supply on stream, that again, I think underpins my thesis around volatility and prices that are arguably a little bit higher for longer. But, look, we've seen really positive news from Sigma recently. I mean, they've entered commissioning and it looks very successful. Lithium Americas has just started doing the same thing as well. And you've seen some other hard rock players that I think are in the zone as well, as we say. So, a lot of reasons for optimism. But again, the supply issue is always, I think, going to linger over this market.
All right, Chris, thank you so much.
Thank you.
Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.